Yeah, hi and welcome everyone to the next episode of FINtastic Talks. And like always, I will like to start with gratitude and thank you for everyone who takes out time to come to these talks. And I hope we are able to add value to you with these talks, and we are able to make your life better. And we are able to help you build that second income philosophy that I always tell you that the difference. You have to first start by understanding the difference between rich and wealthy. Rich means that you have money today, but doesn't take into account the money you're spending. Whereas wealthy means that being able to have money which is going to last you for the rest of your life. So this is a very important thing that you must see. Like suppose you have 1 crore rupees, but you're spending 10 lakh rupees, uh, every month. Then in 10 months you're not going to be rich anymore because there is no fresh income. But if you're worth 1 crore rupees and you're spending 1 lakh rupees and you're earning about 20 lakh rupees a year, then your income is more than what you're spending. So then you're wealthy because your money is going to be able to last longer than you. So guys, it's all about building a second income, which means that your second income needs to be an amount that can take care of you for the rest of your life. So you know so this is what it is all about. And today we'll be deep diving into life insurance. I know we have been picking up on the concept of mutual funds and investments and PMSs a lot, but life insurance is also a very important part of your wealth creation journey, because as I've said, that wealth creation starts with wealth preservation. So if you don't protect what you have built, then there is no use of starting to invest. Example is that if you have built up a factory and that's worth 20 crores and you have not bought the fire and other insurances, and there is a flood or a fire and it destroys your factory, then you're down to zero. And same mostly happens with health. Like most of us don't bother having a proper health insurance for us or our family members, and somebody falls sick or somebody gets cancer and the family spends huge amount of money in trying to get save that person, which is very right. But at the end of the day, they almost wipe out their total savings. So wealth creation journey starts by protecting what you have. So as I always say, first do buy your health insurance, where you have to protect your health, which is the most important asset. Then you protect your assets, which is your car, building, home. You buy the insurances for them. And the third is you buy a life insurance so that you're protecting your family, that whatever the dreams and the goals and the assets and the loans you have taken are all covered, and your family is able to enjoy the life if something was to go wrong. And today, life insurance is also about a great investment. At one time, people used to say that life insurance products are bad investments and you should debundle. But today, yes, they are bad life insurance products, but they are very good life insurance products also, which give you very high guaranteed returns. And the latest products that have just come out are giving an IRR, which is an internal rate of return of 7% or more, which is amazing. And this is tax free. So you get 10 times of coverage as well as a 7% IRR. I think it's a bargain. And today, these products are at par for a high net worth person, at par or even better than EPF and other products out there. So you must definitely look at life insurance. And today, to discuss further on this topic, we are very pleased to have Vishy Viswanand from Max New York Life with us. He's a great it's Vishy Viswanand. So he's been a 30-year professional in this industry with a great amount of knowledge and working in a company which is considered to be a benchmark in terms of life insurance industry in India, in terms of the quality of business that we do. So we are going to be having him with us today. But before we get him in, I want to talk to you a little bit about life insurance and why is it important, and how do you basically do your life insurance need analysis. Now, this is a question which I get very, very frequently asked. Look, my income is, suppose a person's income is 1 crore rupees. How much of a life insurance should he buy? So, if he is not married, he just has his family or his parents. So, you have to understand your parents are also dependent on you for most of the people. They have invested their lifetime in building their children. There may be some situations where parents are not dependent. So, if you don't have dependents, then probably maybe anything between 2 times to 5 times your annual income is enough, depending on what is the responsibility you have on your shoulders for your parents and the extended family. So that's the amount. But if you're married, you and your wife, then you have the responsibility of your wife. And it's not only the lifestyle you live today, but it's the dreams that you have seen together. So in that case, the requirement goes up from 5 times to 8 times, depending on the need. But once you have the children, let's say that you are two adults, husband and wife, and two children, then your life insurance cover needs to be about 15 to 20 times your income, annual income. I know some people may say 10 times, but the reason I say 15 to 20 times, because today term insurance is very, very cheap, and you can get very attractive term insurance. And you also have to see that the interest rates have come down. When we used to say 10 times, the interest rates used to be 10%. Today, interest rates are on average after tax about 5 to 6% is what you will be able to get on average if you were looking at very safe investments. And but yet you are aggressive enough. If you're putting money in FD, you will not get bank FD. You will not even get that much. So if you look at that, today you need to have at least 15 to 20 times, and that is because your income, your cost of insurance has come down, and at the same time interest rates have come down. So you need to build a bigger corpus. So if your person is earning 50 lakh rupees a year, then he should have a life insurance anything between 7.5 crores to 10 crores is what he should be looking at. And when we talk about insurance, you have to look, it's preferred to buy a pure term insurance rather than, term. There is two insurances which are term, which is pure risk, and then term with return of premium. I am more in favor of term with return of premium because, which I will share during my talk, it has some slight more advantages over term insurance, but the premium is slightly higher. If you can afford it, please go with term with return of premium. And also look at the maximum term, because risk of dying is not at 60, 65. It's at 75, 80, 85, 90. So today you have products. Normal product is available till 85, and then some products are available till 99. So yeah, this becomes a legacy planning for you and your family also. So as we get into this, let me invite Vishy to join us for our talk. So Vishy, welcome, and thank you for joining us today.
Hi Sanjiv, thank you very much for inviting me to this forum. Very interesting, I must say, and thank you for creating awareness and education around financial planning.
Yeah, I think it is very, very important that when we look at wealth creation, we just don't look at the overall picture. We just think of wealth creation means investing. So we don't look at it. Wealth creation also means wealth preservation. It also means that protecting your family and ensuring that their life is safeguarded. Your children are able to meet their dreams. They are able to retain their house. They are not running pillar to post. And that's where I think we have a very, very important responsibility that we have to look at then when we look at these things. So Vishy, before we get into this topic of life insurance, which is close to all of us, why don't you give us a brief background about yourself? That what was your childhood like? Tell us a little bit about your parents, your education, and how did you get into this industry?
Okay, well, sure. I'll try to keep it short. Uh, in in two words, you can summarize my childhood as extreme stability. So I've had an extremely stable childhood. I've been fortunate that way. I've been in the same school from my lower kindergarten till my 12th. I've been in the same home for all those years. And both my home and my school were on either ends of a 1 kilometer long road. So it was, very, very stable right through. My parents also the epitome of stability, because for 35 years they've been working in central government jobs. So the first job, last job, retired out. So total stability, and a joint family. Again, all staying together, and touchwood, even now we are all together. So stability even in the ecosystem around. So that's really where what my childhood was, and maybe that's what's made me come into this sector, which is all about the foundation and all about stability, to create, after on which you can jump and create your exotic plans. You can take risks. You can do all of that, but without a sheet anchor, you can't have sails, right? So every ship needs an anchor before putting up your sails, because when the storm comes, anchor will help you, not really the sails. So that's really what my childhood was. Um, why insurance sector? Well, two things. There's usually a push and a pull before you join a sector or a company. I was working in a foreign bank, Sanjeev, right after for about 10 years after my college and all of that. And I was getting this feeling of dissatisfaction, which actually got exacerbated after my bank announced its merger with a larger bank, another foreign bank. And so that started to destabilize things. And I started questioning, saying, I thought 10 years I might retire just like my parents, job, and then retire after 30 years, 35 years from the same bank. What's the problem? But when the merger happened, there was a loss of identity. And what are you doing? Are you the vanquished? Are you the conquered? What's going to happen? And then the family at work was also changing. The people at work were changing the moment the merger happened. I stayed on about a year and a half after the merger. Uh, but that was the push. And I guess the pull came when a call just came during lunch break, and they said, "Why don't you have a chat?" And I went and had a chat, and I realized that that's when I got to know what is life insurance. I was 31 years of age at that time, Sanjeev, and I realized that my first life insurance policy I had bought straight out of college as my first paycheck came, and I kept saving it. It was a 10-year money back, bought at age 21, and at 31 it had matured. And what did it do? Exactly that. It gave my money back. Whatever money I put in, I got my money back, and I had no cover. And I had a 3-year-old toddler at home. And I realized, my God, there must be several millions of people like me out there looking around saying, what have I bought? Why have I bought this? What is it doing for me? And that's what got me thinking. And interestingly, we were one of the largest distributors of mutual funds at that time, as a foreign bank, by the way, mind you. And I had given so much investment advice to people. And then we saw 3 stock market crashes in those 10 years. And I could realize that I could see it in the eyes of my customers, in the eyes of my family members, in the eyes of my in-laws, to whom I had recommended mutual funds. Because when the time when it came down, everybody was down, and people were not able to stomach it. And I realized that, okay, at least in life insurance, there is this two words called sum assured, and that's fantastic. And I think that's what attracted me to this sector. Sum assured, हर product में है, and that assurance, I think, is what is the sheet anchor, which really worked well for me and clicked. And I just jumped on, and I said, enough of retail banking. Let me get into real financial protection and planning.
And which year was that?
Well, this is about 22 years ago.
Okay, so
2000, 2000 November. Yes.
oh wow, so you were amongst the early ones into this industry. So you have seen the massive growth that we saw till 2008, 10, then the 4 5 years of mis-selling, and then the rebirth of this industry, as I say. And this is a story I like to tell people. See, life insurance industry in India, the private sector was born in about early 2000, late 90s. And before that, even LIC, I have to say, is a one company which was doing a fantastic job. So, when I started into insurance industry in 97, 98, I was from the investment background. I'd done my MBA, a lot of knowledge. And I started calculating the IRRs. And I was amazed. I said, where have I come? Not because the IRRs were low, because the IRRs were crazy high. Because that time you had these products like Jeevan Suraksha, which were giving 12% guaranteed returns, for the whole period of your policy and even post your maturity. So for the rest of your life, you were being guaranteed a 12% IRR. You had a product like Biba Nivesh, which was on a single premium used to give you 10%. And at that time, the RBI bonds used to be tax free, were at 8%. Then I said, कुछ गलत लग रहा है. There's something wrong here. Why haven't people caught it? People are selling these endowment plans and other stuff. They are amazing investment products here. And, we started selling those products. And very soon we were doing volumes like 15, 20 crores a month. Because when people realized, and today even, the maximum people who bought Jeevan Suraksha, I was the only one who used to sell it. And people still thank me for it. But there are some people who still ask me, Sanjeev, are you sure it is the right product we have bought? I said, bhai, you have got 12% guaranteed returns, 12% IRR. Don't even think about it. It's guaranteed by the government of India. So, so it started, the private companies came in, they came in with very good intentions. They reduced the term insurance rates. They came out with good products. ULIP products were also good, that, where the intention was to help people take a little bit of market risk. And then, as the industry progressed, there some people came out with products which were not good. And at that time, regulations were not strong enough. And then companies were making money from lapsation, which is very sad, where you pay the premium, you don't pay the second premium. So the companies were making, but then I have to say, this is one industry where we have had some great regulators, and they learned from the mistakes of the industry and their own mistakes. Like, earlier the changes used to be arbitrary. Today we are given 12 months, 6 months, 18 months to make a change. And, so we have had great regulators, and there I have to say the quality of regulation and the regulators has been increasing. Every time I think this guy is amazing, so the next guy comes and even does a better job. And I hope that era continues here. So what has happened over a period of time, in 2014-15, all these plugins were virtually closed. And by 2017, the term rates were amongst the cheapest in the world. But today, we were getting international quality term rates. Companies came up with a 99-year term plan. So which is virtually means that for at least 98% of the people will get a claim. Because if you are buying because this becomes a legacy planning. And people started buying insurance like a legacy planning. My own client said, okay, I have a business which is going to be worth 50 crores, which I'm going to give to my son. So I want my daughter, but I don't want to split my business. So I'm going to buy a 50 crore legacy 99-year plan for my daughter. And that's going to be her share of my wealth. And I'll be paying for that for the next 15, 20 years. So that I'm able to create that corpus for her, and my son has to understand that I want to be equal. So very interesting products came. And then came the non-par products, the resurgence of non-par product. I told you the story about how when I started and I first time I calculated the IRR, I virtually fell off my table here. I said, look, if I'm getting a government guarantee, because then why would I not buy this product? So, today IRRs are fantastic. All companies are offering non-par products between 6 to 7%. Latest series of non-par products which have come out this month are giving a 7% IRR. In fact, and that is so attractive that I was just sitting with my own guys that I want to buy a product for myself. And Vishy, I'll ask you a lot of questions because we have been discussing and debating the employer-employee, because there have been so many changes in that regulations that it's so confusing. So we'll be taking your help. So today, guys, they are fantastic products, but you have to understand life insurance is a long-term commitment. So if you're going to buy it for a long term with your eyes open, like Vishy was sharing mutual funds. Earlier, when mutual funds went up, everybody thought you were a hero. And when they went down, you were blamed. But over a period of time, people have understood that this is a cyclical market. Today, people don't blame you that much because they understand that, life insurance will go up, or sorry, mutual funds will go up and they will go down, markets will go up, and then they'll rebound. So similarly with, with our industry, today we have got non-par products where if you are able to commit for a long term, these are fantastic products to have on your portfolio. So, Vishy, what has been the philosophy of Max New York Life on the non-par side? Do you believe in non-par? Do you still believe in the endowment side? And why would you say if side A versus side B?
Max Life, as we are known now, um, is actually all our decisions have been based on the customer segment that we are targeting. So we find that if we're targeting an affluent customer, by the way, and the customer has dabbled in mutual funds and understands markets ups and downs, and is willing to look for a longer term mutual fund, which will give him some tax shelter as well until very recently, then ULIPs made sense. And with successive regulations which said that if you have to switch funds from debt to equity, all of that started getting complex once the government found a taxation route there. uh, ULIPs were still doing very well, so we do sell ULIPs. Typically about a third of our book is ULIPs in value, but in numbers it might be only about 12%, 12 to 15%. So 1 in 7 policies that we sell is ULIP. When it comes to participating, we began as a participating company, and I'm glad you talked about a permanent term cover. We were the first company when we began. I remember the date when we sold our first policy, 24th of March 2001. I used to be an office head down south in Chennai, and there we only had a whole of life plan, a participating whole of life plan. So it's a plan that will outlive you. And when clients used to ask us, ये आप क्या क्या प्रोडक्ट है, कब मैच्योर होगा, we'll say आप कितने साल पे आप अपना हेलमेट पहनना छोड़ेंगे, at which age will you stop wearing a seat belt? If the answer is no age, it protects me, then this is a protection which is always there. And if you want to dip into it and take out cash, it has cash value. So it's actually a term plan with cash value, which is growing at a reasonably good rate, and all the bonuses declared never comes down, like your PPF. So when people understood that concept, they started buying that, and we were a company which were formed on participating. And today we are seeing that about again 1/3 of our book, about 25-28% of our book is participating plans. The balance, close to now 30, 35, nearly about around 35% of our book is non-participating, fully guaranteed savings plans, and the rest is typically annuity plans, which are pension plans, and pure term plans, non-participating protection plans. So that's where we are. In numbers, they are very different though. Nearly, I would say about 30% of our new policy holders are only term purchases, pure term purchases.
Okay, very interesting, Vishy. Very interesting facts that you have given. So there's a question or there's a statement given by one of our viewers, Pandi Ramanathan. He's saying that he must have read one of my articles where I said you do not sell a life insurance product, but you help a customer buy the right product. So Pandi, thank you for reminding me of this. And this is where I mean by what I meant by this is that life insurance is a solution. It's not a product. So if you start selling life insurance as a product, then you and the customer's need is not going to match. So, I always tell my team that you have to help a customer understand his need. And then you have to show him the products that help him meet that need. And that's where, so you don't sell this product, but you help a customer buy this product by helping him understand what is his need, what is the risk he can take, what is the time he can commit. And if you do that, then you're actually giving a solution which a person is going to remember. People don't remember products, but they remember a solution. And in fact, I remember one time iPro has done something very interesting where rather than the products, they were actually tagging the solution that the person was buying. So if the person had bought a solution for his child's education, so they would say that you have bought a child education plan for your son Surya, and for that you have used this product. So that always helped the person remember that, look, why did I buy this product? Why did I choose? So friends, for those who are into this industry, And even for the viewers who are watching, and Vishy, we have more than 10,000 live viewers watching us today. So even for all the viewers who are watching, that please go and work with the right insurance partner who can bring you multiple options and who helps you understand your need so that you can choose the right product for you that will meet that need. And that is very, very important. Okay, and then again, we have another question from Piyush Saini, that can we buy term insurance for asset diversification? So, Piyush, that's actually a very tough question you have asked, because you generally buy an investment product for an asset diversification. But like what I was explaining, but yeah, if you are talking about a 99-year term or a legacy planning product that you buy for as asset distribution. So between your various children or your estate distribution, you can use a 99-year term product to distribute estate between your various children. Because some people don't have business which can be divided in 2 3 children, or one child is deciding to be an employee, he wants to be a professional, but there is family wealth and he needs to get a part of that family wealth. Some parents will just leave that wealth to all 3 children, and that totally destroys the business. But if you would really want to create a legacy, you want your company to last longer than you, then the right way would be, and in fact we do it for a lot of our customers, that where what we do is we will help them buy a 99-year term plan to take care of the remaining siblings who are not actively a part of that business. So yes, it can be used for that. And Vishy, again, Pandi, one of our very regular viewers, is asking, pure term or term with return of premium, term or trop, which according to you is a better option? So I will let you answer. I have very strong views on that. I will add there, but first I'll let you give your views.
Sure. Actually, we've been also stuck with this term or term with return of premium. And there are different segments we thought. And then we actually questioned ourselves, and we had a brainstorming with our actuaries. And guess what? We said we don't have to decide now. Why should you put the customer in this 40-year decision? It's a 40-year term plan on an average. So when the policy term is for 40 years, why do you put the customer in this conundrum to take a decision today? Why can't he decide tomorrow? Situation can change. He might want to continue it, might not want to continue it. Why can't you offer a return of premium plan after age 60 or 65? Buy it now as a term plan and price it competitively like a pure term plan. And guess what? We did it. We were the first company to bring out a special exit value. The price is still very competitive. And so you're not paying, let's say, 40% higher or 50% higher for a term with return of premium. And you had the choice after age 65 to decide whether to exit the plan and get back all the premiums you've taken and close the policy, terminate the cover, or let it continue till age 85 or 75, whichever your contracted tenure. It is your choice. And that became a market seller and market hit. And today, actually, this question needn't prevent people from buying now. I found that people get confused when you're offered such a choice, and that too in such a long-term product. And we found that actually doesn't matter. It is okay. We can still price it well. So we are still leaders in the market, Sanjeev, especially in the market where people who are buying insurance on aggregator websites, online, or even from insurers' websites, 1 out of 3 policies being purchased in India is from Max Life. And these small product innovations, questioning these holy cows, I think is the secret to that success.
Very well answered, Vishy. Very well answered. So, guys, for me, it's I'll add my 2 bits. I think between term and trop, if you can buy it, afford a trop is better. The reason I say that is that you get a paid up value. So, what happens with a term plan? Suppose you have bought a 40-year plan. After 5 years, you get a cheaper plan, or you decide not to pay the remaining premium for some reason. You get zero benefit. Whereas with a term or with a return of premium, since you have paid 5 years premium, that means out of the 40 years the product that you have chosen, you have paid an X amount of premium. So when you do a paid up, you convert it into a paid up, you will get your sum insured, suppose that was 10 crores, you'll divide it by 8. So you will still get that amount of money, or that 1.5 crore of life cover, which will be there for you for that 40-year term that you had thought of. So that is one advantage. Plus, also there is, whenever if you suppose you forget to pay the premium in a term plan, you only have 30 days, and most of the companies after 30 days will insist for a fresh health cover, health checkup, and you will have to give the restatements again. And there is a law in this country that after 3 years no claim can be rejected, after 7 years absolutely no claim can be rejected, and you lose that benefit. So point is, whereas in case of a trop, you get 6 months to be able to reinstate your policy. So these are small things. Plus, in a term premium, you pay 18% GST. In a trop, you pay 3% or 4% GST. So so the difference between term and trop due to GST has actually come down. In fact, Vishy, there's a very interesting. I don't want to take a name of a company, because this, due to this GST arbitrage, their top premiums were lower than their term premiums if you added the GST into it. so so it depends on the situation. But guys, I will always, and this is also there, that you should buy limited payment terms. The limited payment term, suppose you're buying a 99-year term, don't try to choose a premium age till 99. Try to choose it, you should be able to afford the premium, but try to choose a smaller term, maybe 20 years, 25 years premium, so that if you have paid the premium for 10 years, you get a paid up value there also. So I'm trying to tell them some quacks and hacks from our industry. And I hope no actuary is watching it and he tries to plug them in. So,
no, these are good features and flexibilities which everyone should know.
Yeah. So now coming to our next question, Karan Bisht is asking this question: what are the tax benefits related to life insurance nowadays, Vishy?
Well, you have the Section 80C tax benefit, but of course there are many things, including your provident fund, including any other, let's say a 5-year tax FD, anything can be put into that. That's your Section 80C. But we're finding that the relevance of that is actually reducing in India because of the plethora of other opportunities that you can use to avail this limit. The second is, or rather the unbeatable limit is still the unbeatable tax benefit in life insurance is Section 1010D, which is the maturity corpus of the policy, which is tax exempt. Now, obviously, one knows that the maturity has that accrual and has the bonus or the interest which is being credited, and that becomes tax free, provided so as the cover you greater than 10 times so that benefit leads the on Section 10D, the maturity over 2.5 lakhs will be taxed. If you had a plan, if you take a plan which has more than 2.5 premium, not just on one policy, combined to the. So in a nutshell, it's really look at 1010D benefit, which is the time when you'll get the best, which is your sum assured, you'll get your maturity bonuses or your interest, which is committed to you or guaranteed to you, and your policy will remain persistent, as Sanjiv said, so that you don't have a remorse of what if something were to happen and then you find that you're not insurable, you can't reinstate your policy, or you ended up not having any cover. So keep your plans. If tax were to motivate you, it's Section 1010D, which will support you there.
Yeah, so I think very well answered, Vishy. I will just summarize it for you. So, guys, one is ATC, which is at the time of paying a premium up to 1.5 lakh rupees, where there are now a lot of other products also available. So that is there. Then Section 1010D is the big one. So if you're buying the right product, which is eligible for 1010D, which is most of the products where there is at least 10 times of your premium as a sum insured or 10 times or more, then your whole maturity corpus is tax free. So, and whenever a life insurance claim is paid, that is tax free unless it's an employer employee or a keyman insurance, which we will deep dive into later. So, this is there. Another big tax arbitrage available is a Married Women's Property Act. So MWP Act I'll give a very brief answer to it, and I'll let Vishy explain it in further details. So Married Women Property Act is a very unique act on which you can assign your life insurance policies, which says that tomorrow if there is any legal action, criminal or any liability on your family or yourself, then your creditors or other people cannot claim that for money from your family. Otherwise, what happens is that if you have taken a loan, even your children and other people are made a part of it. But if you have bought an insurance policy with an MWP Act as nomination ticked, then nobody can claim that money. That money is going to be there for your family. And this is called Married Women's Property Act. So, Vishy, if you can explain that a little bit more to our viewers today.
Sure, Sanjeev, you explained it very well. That's really what it is. It's an ancient act, more than 100 years. The women to ensure that come what may, including government agencies, income tax, enforcement directorate, CBI, no court can actually instrument which is Married Women's Act compliant. In life insurance, it's very simple, but during purchase, you have to just do that. So that's really it. So if say in a bankruptcy situation and the banks are after you, courts are after you, this amount and the cash can be for your property can be, but this can be touched. So liquidity in terms of need. So that's what is the Married Women Properties Act. Most self-employed when everybody is the government is around you, this makes sure that this corpus and the funds in this corpus of this insurance policy is available to you at any time.
Oh, guys, we lost Vishy. So let me just explain it to you that Married Women's Property Act means that this money is for your family and nobody else can touch it. And this is one of the big reasons why people buy life insurance. And for you also, when you buy a life insurance, you're actually buying it for your family. So please do discuss with your broker or agent that whether you should be using this or not. And if you can, and it makes sense to you, must put an MWP Act. Now, taking the next question, we have Ramesh Pandey. He's asking us a question: is my corporate insurance enough to cover my life insurance requirement? So this is a very important question. We get it in life insurance also, health insurance also, that we are being given a corporate insurance. In health, it is generally between 3 lakhs to maybe 10, 15, 25 lakhs. Or on life insurance also, we are getting protections from our companies. But let me tell you, look, unless you're planning to work in your company for the rest of your life, then your corporate insurance is not enough to cover your insurance requirement, individual insurance requirement. Because as I explained, your greatest period at risk is between the age of 70 to probably 85 if you're buying a normal product, or between 85 to 99 if you're buying a whole life product. So that is the time where you need the coverage, and none of the corporate plans will give you coverage at that time. So that whatever premium that is getting paid for you, the legacy planning that you want to do for your children, today it's very important. Like, let me take an example. Earlier, our parents used to keep a corpus of 4-5 crores. They wouldn't sell a house so that we can give it to our children. And they were not able to live a good life. And you would have seen that in the movies like Bagban and others. But today there's a new concept. I buy a life insurance worth 5 crore rupees. for my children, and that money is going to go to my children, so I can afford to blow up my money till I live, and I can live like a king. In fact, I have done it for so many people, where I've told them, like, please use your money. This is your money. This is one life, and you want to give some money to your children, buy a life insurance for them. So, friend, life insurance through corporate is an add-on cover, add-on benefit. Don't take it as your protection. You need to buy your own product if you truly want. Because tomorrow you leave your job, or the company decides to withdraw this benefit, and you have had some critical illness, or you have had some high blood pressure, diabetes, even so you will get a very high premium at that time. So it's important for you to buy your individual policy. Anything you want to add here, Vishy?
I completely agree with you, Sanjeev and Ramesh Pandey. Good question. We are all corporate employees, and not very long ago, during COVID, I could see that employers were thinking twice about what policy they wanted for their employees, what conditions and preconditions they wanted for the health cover and life cover, because the premiums went up in many cases almost 10 times more in just for a 1 year cover. So pandemics could happen again, and then your insurer might just decide to cash out, or your employer might decide to cash out and say, here is the money, I'm adding it to your CTC, you buy your own policy. And then what will you do? At the time you should be insurable, right? At the time you should be able to afford the premium, right? And that's up in the future, and that day is not too far away. India is perhaps among the only countries where the insurance is provided by the employer, though not shown in your CTC, while abroad, actually the insurance is actually deducted and payroll deducted from you, and you choose the provider. Maybe you get a kind of discount because you're going in as a group. So why will India be any different? Maybe 5 years, 10 years, we will also go that way. And when we go that way, please do not find yourself uninsurable. So as Sanjeev said, buy your own policy, क्योंकि ये आपका है, ये आपका हक है, अभी ले लो जब मिल रहा है. Because बाद में when you want it, you might not get it.
Yeah. So in fact, there the regulator has already understood that it's very wrong. It's not unbeneficial to have a corporate insurance unless it's for a specific purpose, that they are sending you to very high risk area. They need to give a coverage to your family for 1 or 2 years. But for a normal place, internationally, you are given an amount and you choose your provider. Similarly, in India, you should actually choose your provider. So again, a very interesting question we have from one of our audience, Rajendra Pandey. He's asking about the gratuity pension plans or the 6.5% IRR plans. Can you consider them as your part of your debt fund investments? So Rajendra, your question is absolutely right. That today, the guaranteed return plans are actually an alternative to debt funds, and in fact, they are better. Last 2-3 years, debt funds have not performed, and here at least you are getting that 6.5, 7% guaranteed tax free. So they are today equivalent to the best of the best debt funds, and the kind of risk you have is much lower because these are guaranteed first by the product, then by the shareholders of the insurance company. So you have a double, insurance guaranteed return products or non-par products. There is a double guarantee. So I think they are definitely, you can consider them as an alternative to debt fund in your portfolio. Vishy, anything you like to add here?
That's right. It's like having a debt fund and then doing a systematic withdrawal plan, right? Every month, typically. You can do that. But guess what? It will run out sometime. Sometime it could run out, especially if inflation is higher than the return that is there. So that is available. So here, the beauty about this is that these pension plans, the risk is on your life, and the risk is taken by the life insurance company. So the longer you live, the more you make. The longer you live, the more you make. And guess what? The most popular products are not just for you, but you and your spouse, which means either or survivor, the longer you live, you won't have to be dependent on your children. You can be on your own, standing on your own feet financially, and you can do that planning today. So that's the advantage of it. And post the demise of you and your spouse, this can be willed as a legacy. The principle can be built as a legacy to your children, so they'll still love you. These are fantastic plans, and it's very, very popular. And I must share with you that this particular line of business is the fastest growing line of business for Max Life.
Yeah, so pensions and annuities becoming a huge area, and we'll be deep diving into it. And जैसे Vishy said in Hindi, they say ना माल है तो थाल है. So your children will love you if you give them money. So now coming to the next question, that Shreya is there's a viewer called Shreya saying she's asking a question: can a person choose to pay premium for lesser than the policy term period? This is a very simple question, but a lot of people don't know this. Yes, you can choose to have a PPT less than the policy term, and this is what we generally recommend in very long-term term insurances and others. So if you are buying a 50-year term or a 99-year term, restrict your premium paying period to 10, 15, 20 years so that it is more controllable and you can understand that how long are you going to be paying the premium for. And next is a question by Shirish Dave. And Shirish has asked us a tough question. He says, why person who sells insurance keeps making money on every premium one pays? So here, Shirish, because insurance is not about the buying the protection alone or buying the product, it's also about helping you get the claim. So let me share a story that 75% of the claims that are initiated by Bajaj Capital are actually initiated by Bajaj Capital, because the family has either forgotten or didn't even know the person had a life insurance. So when we are doing our follow-up for renewal, Bajaj Capital is one of the unique companies for our wealth business. We have 100% persistency rate now. Okay? And for our overall business, we are at about 90 to 93% persistency, because we truly believe that if a person doesn't get benefit, this 7% or 8% people who are losing money and not renewing or even opting for a paid up is a very sad situation for us. So point is that, look, it's for the claim. So the aim is that to have that broker or the insurance agent available to you for your family, because at the time of claim, because you're not going to be there. So somebody has to follow up on your behalf. And वो बोलते हैं ना, penny wise pound foolish. Why should we get jealous of what he pays? We should get proud of what we earn. अगर हमें IRR अच्छा मिल रहा है and he's making a little bit of money, let him make money. You know, at the end of the day, we want to go direct. We want to go there. Please also understand, direct me, it's the insurance company and the aggregator who's making money. So even in that product, somebody is making money. So don't bother about the money other person is making. Bother about the money that you are making. Vishy, what would you like to add to this?
Yeah, as Indians, we hate paying any money for any service, right? हमें सब कुछ free में चाहिए, actually. So even when you go to a restaurant, we hate paying anything called service charge. But guess what? The price that you see on the menu has all of that built in, isn't it? But we don't want to know about it or think about it. The petrol that we fill in our cars, we want it free of charge. But guess what? There is the government charging tax on it. There's the petrol vendor who's supplying to it has a charge on it. Everyone's taking money, but you don't know about it, right? So here, especially in insurance contract you live, we specify and show every year how much is the commission. And I must clarify that in health insurance, motor insurance, or any such general insurance covers, every year you end up paying about 15% of the premium as commissions on an average. Now in life insurance, it is not so. In life insurance, typically the average payout is 20% on a blended commission basis, and the renewal commissions are downwards of 5%. It's between 1 and 4%. That is the renewal commission. How is that commission going to help? That commission is going to help in the person who sold you that policy will know that, okay, I'm selling you this policy so that you stick with that plan, and I'm here to support you and serve you. So at least you will be more trail commission is there, the less chance of you being missold. So remember, it is protecting you, number one. Number, when it comes to a claim or a maturity or anything else, there is a person who can help you get that things done, and you don't have to pay anything more. The premium that you pay in a life insurance policy remains contracted for the entire term flat, while the commissions earned by the agent is reducing every year significantly compared to the premium. So be cognizant of that, and appreciate the fact that, guess what, if it's working well for me, it should be working well for others as well. Otherwise, who's going to sell you the policy? Then you have a choice of going and buying it directly online. And I must tell you a secret: if you even if you go and buy online, you think it's for free. You think that the insurance company should be saving money on the commissions. Guess what? You're absolutely wrong, because we end up paying Google, we end up paying Facebook while you search and go and buy and click and buy that policy, right? We end up paying that call center agent who calls the customer and explains the policy, sometimes even fills the form online. So there is a cost for all services. Thank God it is built into the premium. Otherwise, it becomes a great excuse for many of us Indians not to buy anything and not to do anything in life. And then wonder, how do we work? How do we do it? I mean, just ask ourselves, when you open a bank FD, do you know how much is the charge of the clerk who's of the cashier and the clerk who's opening the FD for you? Who do you think is paying that salary? We as consumers, right? So every service that we incur is being charged and paid. And I think the wisdom is, like, am I getting value of it? Please be selfish. If you're getting value for it, it's a good deal. If you're not getting value for it, it's a bad deal. Does not matter whether it is commission paid or not.
Yeah, in fact, there was a very famous, professor, and he had written a book, and there was this very good research study also done on that. That there are 2-3 employees in a company, they all work equally hard, they are all very very committed, and but there is only one person who grows to be the CEO. And they said, what is the trait that helps a person become a leader, or helps a person become a king? So king man, this is something which is said in Gita. Who is a king? King is a person with a large heart. So point is, apna dil bada karo. The person who has a large heart, gives more, is the person who will become a leader. So a lot of professionals think that, look, I work so hard. Why am I not growing? Why am I not the leader? Because you don't have big heart. तुम वो कहते हैं ना, चिंदी चोरी, कि अगर आप छोटे छोटे पैसे बचाओगे, जब पैसे बांटोगे तभी पैसा मिलेगा. एंड एज इवन भगवत गीता में भगवान कहते हैं कि दिल बड़ा करोगे, जितना दिल बड़ा करोगे, जितना दोगे उतना ही मिलेगा. ठीक है? So you have to enlarge your heart. Don't look at what the other person is making. Look at what you're making and be concerned with that and buy the product on that basis. So now there are a lot of these small questions. We are a little bit short on time, and we have a lot of things we want to take up. So, there is Murali KS. He's asking a very important question. They're asking that he wants to buy an annuity plan, whether he should opt for return of purchase price or only annuity. So here, Murali, depends on your family. So if you don't have, dependents to whom you want to give a lump sum benefit, then you should buy only annuity, because you don't want to give, you want to consume your money. Whereas if you want to leave a corpus for your loved ones or your children, and you just want to live on the interest rates, then you should buy with the return. You should buy with the return of purchase price. Return of purchase price means कि जो आपने annuity का principal pay किया will get paid to your children. So Vishy, would you like to add there, or should we just take up the next question?
Sure. I'll give you a quick actuarial answer. Go for the return of premium, because when we price the product, we don't price for mortality risk. Okay, so it's not that the difference in pension that you will get between a return of premium and without return of premium is significantly different as in US market or Europe market. It is not so. The difference is very minuscule. So you rather stick to the principle and get your corpus back.
So that's very well answered, Vishy, and that's something I've seen, that with return of purchase price and without return of purchase price, the kind of difference that we should be seeing in the corpus, because mortality risk is not being, and you clarified that mortality risk is not being factored into India. So it makes sense to get a return of the purchase price. Next question is by Muskan. She's saying, can a person buy 2 life insurance policies and claim for both? Yes, you can have even 10 life insurance policies. And if something happens to you, you can claim for all of them. Suraj is asking, what is the advice for young people who are looking to start investing in life insurance products? I will quickly say, Suraj, it's very good to buy a term insurance as early as possible, but buy till the age of 85, because life insurance has the concept of flat premium. So when you buy at a lower age, you will get a much lower premium, and if you buy the same policy at an older age, you'll pay a much higher premium for the rest of the term. So if you look at it, if you are getting covered for 60 years, suppose you're buying a 85-year product at the age of 25, you will end up paying much lesser premium if you buy it at 25 than if you were to buy it at 55. And plus, there will be many restrictions, extra things may not get covered. Vishy, anything you like to add here?
Yes, surely. Term plan specifically, especially the increase in premium on each birthday of yours is between 6 to 8%. So, आप 3 साल बाद decide करोगे, then for the rest of your life, you're going to pay almost 20-25% more, which you could have saved for for the remaining years if you bought earlier. So it's always good to buy when you're young, and it's always good to buy when you're healthy, because guess what? In life, health goes only one way. It doesn't get better. It only gets worse, right? So buy it when you're healthy, and buy it when your premium is low.
Yeah. So Rajendra Pandey is asking us a question that why do financial experts advise not to mix insurance and investment? That was because maybe 7-8 years ago the insurance and investments were better apart because we didn't have guaranteed return plans. So these things change. They are reading textbook which was written 15 years back, and I wrote that book for financial planners in the India, and at that time that was the right advice. But today, you have products, so you have to look at the product and its merit. That if it's giving you a 7% IRR plus a 10-time life cover, why won't I buy it? It's a no-brainer. Even if it's bundled, I don't care, because my debt fund is not going to give me that amount of return, and the kind of risk I'll be taking in debt fund is going to be much higher. So Pradeep is asking which products are giving 7% IRR. Pradeep, that's a long question, but quickly, HDFC has launched products. Tata is launching, maybe Max. I don't know, Vishy, what's your roadmap for increasing the IRR on your guaranteed return products?
You'll soon find them in 1 week's time, the highest in the market. So that's all right. So yes, all these returns are close to 7%. And you'll find that that benefit is there. And especially if you buy plans which are whole of life kind of plans, which offer you income stream at this IRR till you're around, guess what? Then that means you're beating even the market. The longer you live, the more you make.
So then we have Pandey again asking a question. I think he wants to take his decision. So he's asking between guaranteed return plan or annuity, which is the right choice for the aged 55. So I'll quickly answer this, Pandey. It's basically, I'll say guaranteed return plans are better because there the maturity is also tax-free due to 1010D. Whereas annuity plans, the maturity is taxable. It gets added to your income. So if you have the time to wait at 55, you can wait for 7-8 years for the annuity to start. Then it makes sense. And if you are healthy, you are able to get the life cover, then go for it, guaranteed return plan. If you're not able to get the life cover, then only you should look at the annuity plan there. Next question is by Robin. Is it a good idea to replace current policy with another policy with better returns? Robin, I'll let Vishy answer, but for me, the answer is yes, definitely, because as I said, we talked about the evolution of insurance over last 15 years. Today, like my own term policy I had, which I had bought 10 years back, even today, despite being overweight, I can get the product at a cheaper rate. And about 2 years back, 3 years back, I decided to change my product before COVID because I was getting a much better product at a much lower price, and I took a paid up value in the earlier policy. So yes, you can always take these decisions because if the newer product is better, why not? Vishy, would you like to add anything there? I know we are going against the normal norm of insurance, but in spirit of customer centricity, I think that's the right way.
Yeah, I suppose look at the future rather than the past. Often we take these decisions based on the past, but don't. Look at the future, because typically life insurance policies, the charges, the period of charges happens in the first 3, 4, 5 years. After that, it becomes very, very positive in terms of an IRR and return for you. Compare that with the new policy that you're thinking of shifting to, or rather stopping this and getting in. So look at that future trajectory and see where are you paying more. It's very visible, it's very obvious if you look at the illustrations. And you go to one advisor who's the new incumbent, new person, they will tell you please replace. You go to the incumbent, they'll tell you don't replace. So best is to go and ask both, and then you take your call.
Okay, so we have a huge list of questions, Vishy. I don't think we can go through all because we are already very far above the time. But one last question, let me ask you on employer-employee, what's the taxation policy today? There are a lot of people who are asking this. We have a lot of entrepreneurs who are watching it. They're saying, if I buy an employer-employee policy, how does it get taxed nowadays?
Well, if you buy an employer-employer policy, best thing to do is to go to your chartered accountant, ask him, does it stand the test of an ACIT scrutiny, right? The Assistant Commissioner of Income Tax scrutiny, they will know better than anybody else. And we've seen that almost, we've not seen any cases being contested, okay, so far. And I've been around here for now 22 years. So all these cases go through and they are legitimate. The insurance company also does that due diligence upfront. Please remember that we will not allow any employee of any company to be able to take an employer-employee. So we will be cognizant of the fact that we're not trying to stretch the key man policy into an employer-employee. We will ensure that that is not so. And with those safeguards, I think you're in pretty safe territory. But consult your chartered accountant always in tax matters. No insurance company is an expert in tax matters. For that, your chartered accountant is the expert.
Yeah. So also, I'm not an expert on this, but Bajaj Capital is. So, please send your query to Bajaj Capital. I'm sure we have teams and chartered accountants who can answer this question. So I would not like to answer this question because that's not my personal forte or something I've looked at. In fact, I'm looking at these answers for my own product and policy. So, this is it. And there are a lot of people who want to get a job with us, Vishy. So, guys, we are always very, very happy to recruit. I can say it for Max Insurance. I can say it for myself. So, please do apply. Team, please put up a QR code which helps people who are looking for a job. We also have a program called IDWM, International Integrated Diploma in Wealth Management, that we have created. So a lot of freshers want a job. Now, they have no clue about the finance industry, about financial planning, about life insurance, insurance planning. So even if they get a job, they fail. In 2-3 months, they lose the job, or 6 months, they lose the job. So point is that what we have done is that we have created this 6-month program where 3 months we do hardcore training for you. You would do CFP level 1, you would do all the regulatory certifications required by law, IRDA, SEBI. And then next 3 months, you get an internship where you get paid. So you virtually get your what you have invested in the program, you get it back. And after 6 months, you start working. So in that sense, and you get a higher start than a normal fresher would get. So you are actually within 1 year, you have recovered everything you have paid, but the chances of your success have become much more. So if you look at, you want to join a bank, you join through a banking program, you'll do much better. Same is with the financial services industry, whether a wealth manager or an insurer, it's better to go through these programs. Look at, they have given the code for IDWM. Just do a search IDWM. I think you will not remember that long a link. So one last question I have to take, because this is a question by one of the viewers. He's saying that I heard Axis Bank owns a significant percentage of Max Insurance. Then why is it not called Axis Max Insurance, or why is the Axis Bank name not in the name of the insurance company? So what is Vishy? I'll let you answer that. It's a very interesting question.
That's an easy one. The Axis Bank and its related entities, have invested 12.99% in Max Life, and they might go up to 19.99. Now, if you consider that big majority, whatever, that's up to you, but that's where it is. Not more than 1/5. Number one. And number two, you're right. we have Axis Bank in our name and in our visiting cards. It's there in our sales literature. You can go to our website. It says a joint venture of Max Financial Services and Axis Bank. And we got the Axis Bank logo and burgundy there. Interestingly, Sanjeev, the moment we did that, we found that online, people considering Max Life going up, because I think the Indian citizens' belief in banks is very high. So that's only helped the company. There's no need for us to change the name, and I guess Max has built its own credibility, especially by being the number one claims paid ratio company for the last 5-6 years in a row. So we've been able to build that, and I think Axis is also very happy with the name Max. Thank you.
Yeah. So, guys, so you get max returns with Max Insurance, huh? So, guys, thank you, Vishy, for joining us today. I know there are about 50, 60 questions we have not been able to take up. Thank you for writing so many questions. And if anybody has any questions in their mind, please do write it in the comments. And because these are all coming to us, whether you're writing them in LinkedIn, Facebook, Instagram, or any other area where you're, or YouTube, wherever you're watching it, please write any questions you have in the comments, and I will make sure our team answers all questions. And I'll just ask my team to put up the QR code for people to ask any questions. And our apologies for not being able to take up and some tech glitches that we had during the way. So thank you, Vishy, for joining us, and thank you to all the viewers for being with us today. It was great having you, and more than 10,000 people joined us live. That's supreme gratitude for that. Thank you, and we hope we were able to add value to your time, and we were able to help you build a better life. Some last words from you, Vishy, and then we say bye to everyone.
Well, thank you so much, Sanjeev, to invite me to this forum. It's a pleasure to especially interact live. I suppose we are in that cusp of this sector where, 2 decades ago, people were asking us why insurance, to now what insurance. ये नहीं पूछ रहे हैं कि क्यों चाहिए इंश्योरेंस, पर आप बताइए प्रोडक्ट के बारे में, फीचर्स के बारे में, फ्लेक्सिबिलिटीज के बारे में. So the why has become what, and I think in the years to come, it will become wow insurance. So look forward to that and make insurance purchase, ownership, very well prevalent and a pleasure for every Indian in this country. Thank you.
Thank you, everyone. Thank you for joining us today.